have to be willing to adapt to where, certain things are working, adapt to Bitcoin, adapt to some of the short selling stuff, adapt to, grow, just like you're adapting where we're seeing, large cap tech do better and start to come back. I mean, people don't realize this, but since November, large cap tech has significantly underperformed the markets, right? Up to like 2-3 weeks ago. And, we have some big earnings out from the majors and Facebook and Google and Apple this week. But, I don't know, just to see the rotation in money and cyclicals and small caps surging 25% in a month in November. I mean, the highest ever in a month. Just understand this is the new market. This is where volatility is. Who's going to do great in volatility? What sectors are going to benefit from the new administration? It's not so much where, the market's going to crash. Certain sectors are going to do bad and certain sectors are going to thrive. Anything climate change, have you heard? Hey, Daniel, you're going to love this because I know we talk about climate change, but every single company, now that Biden is one, every single company is coming out and they're saying how they have initiatives for climate change and we need to say they have to, right? They almost mandate it. You have to do that or they're going to come after you. The mob will come after you, right? When I say mob, it's in social media, they'll attack you. This company's terrible. Your own employees. We've seen it at Facebook, right? Attack Zuckerberg. But every single company's announcing that initiative. They're putting money into it. They're allocating money. That's what you need to understand. Whether you believe in climate change or not, every company is allocating money to it. Doesn't matter if it makes sense or not. So it's up to you to be pissed off if you don't believe in climate change or be happy with it, or you can make money on it, right? And that's what we choose to do here.
Yeah, absolutely. I mean, I think there was a SPAC that, an ESG SPAC that went live today. It was across CNBC this morning before we started taping the podcast. Yeah, I mean, that's definitely the trend that we're heading. That's the roadmap you want to follow and at least look into that. So everything, when there's some executive orders coming out that are making the oil markets volatile, you could argue, with no more drilling on federal lands and all that kind of stuff. But yeah, companies are going to front run that. They're forward looking as well. And if capital can flow into there in a good risk reward way, then we'll look for that as well and hopefully benefit from it.
Yeah, no, absolutely. And you said something about SPACs. SPACs is another thing, right? It's a vehicle that's created, special purpose acquisition company. What they do is a holding company that trades publicly, and then they'll go after a private company and purchase it. And then they'll, it immediately becomes public. Now, so many of these are being, it's insane where, I got some numbers here. 194 traditional IPO deals raised $67 billion. This was as November 30th, right? I think it's like $90 billion now in total. That's the best since 2014. So 194 traditional IPOs deals raised $67 billion. So that's IPOs. There was 200 SPACs in the same time frame that raised $64 billion. So 200 SPACs compared to 194 traditional IPOs. SPACs raised $64 billion as of November 30th. And traditional IPOs raised $6-7 billion. So we're looking at it taking half the market right now. Again, it's going to explode this year coming up. But there's lots of things that people don't understand with SPACs, where it's basically a pyramid scheme. That's what it is. I mean, you have the early investors.
Boy. That's going to get some attention.
Yeah, but it really is. I mean, so you have the early investors. That's why all of a sudden you see Goldman Sachs. You see, all the major players are now getting involved. We all have, it's not just. You have Bill Ackman, Chamath, now you have private equity, Apollo Group, all these guys, and TBG Capital, and
Shaq's involved in some of them.
But now you also have the Goldman Sachs, the Fidelity. All these guys are getting in because the fees that you make up front when you create these things are enormous. And when they'll raise like $200 million, just say, and then what they want to do is try to purchase a company 4x to 5x larger. So that's what they'll do. It'll immediately become public, which you bypass the entire IPO system, which basically tells you it's broken, right? That's why it's broke. That's why they're allowing SPACs, right, to do this, and everything's cool with SPACs. It's fine. It's awesome because everybody's making money. Everything is always cool when everyone's making money. And the only way SPACs work is if you have an amazing retail market that's willing to buy after the fact, and they'll buy. A lot of these things come out $10, which is no reason why most of them come out at 10. And it'll go to 15, 20, and you have the retail crowd buy 20, 35, 40. As long as you have that, everyone's happy. Just realize that retail crowd is buying it at 15, 17. These guys are in at $1, $2, and they're making an absolute fortune, and that lockup period is only 4 months. What we need to see about these SPACs, Daniel, is how are they going to perform after that 4-month period, after 12 months, after 2 years? Because these guys that are, that's what pisses me off when I see some of these guys. We're creating an alternative energy fund, or could turn this, SPAC. These guys are in it for the short term. You put a ton of money in there, you get out in 4 months, now you're liquid and you get into the next SPAC, right?
Yeah.
So that's the goal of these guys, where you want to be liquid and you don't have to worry about buying private companies where you're going to be in them for an average of 7 to 10 years. Think about if you invested early in Facebook. Peter Thiel couldn't sell out of his full position. I mean, outside of a few ways you could do it if you have, you're raising capital in seed rounds and stuff like that. But, it would take like 6, 7, 8 years, whatever it was. Same with Airbnb. I mean, that company's been around forever, right? 2007, 8, whatever it was. And it's just public. So, you're locked up. Your money is locked up. With this, it's 4 months and you're gone. And more to the point here, Daniel, and sorry to be talking because I want to bring you in here with SPACs. So they look for companies that they're going to buy 3x, 4x greater. When they buy them, now they still have to get that capital. You know how they do it? They do it through PIPEs, right? Private investment, public equity. So they have to get individual firms and say, hey, we just bought this. Do you want in? And they'll be like, yeah, what are you going to offer me? Well, we'll offer you warrants. If you want to come in for 50 million or 100 million, you get warrants, you get special deals. And we don't even know. They don't disclose what these deals are. So we don't know the warrants outstanding. We don't know anything on these SPACs, but yet all these guys are getting deals to where they're making money almost up front right away. And it only works if the retail crowd continues to buy because it goes higher and no one's bitching and complaining. That's going to change. And it's going to be interesting to see what happens within the SPAC industry. But again, this is something that we talked about, and I just want to throw the points out there. I know I want to get your thoughts on this, so I was just talking a lot there, but go ahead.
Yeah, the numbers you threw out there and stuff, I think there's been over 60 of them this year. We're not even through January. They've raised billions of dollars already. I saw on a stock market MBA website, there's over 250 SPACs out there looking for deals right now. It's just incredible. You're right. You do need a strong retail base to continue buying it. And I do understand the emotion behind it, because what I like about SPACs is just a fact. It's a better alternative to an IPO. And we don't have to get off on a tangent here, but it's like a security token. It's a better way and a faster way and a more efficient way to go public. So the SPAC idea, I really like. Can it get abused? Is it being abused? Yeah, probably. I mean, a lot of these guys can get out. Like I said, I hate the fact that it's very hard to find information on the different pipes, investments, and levels like that. That's what sucks. But, the idea, it's always going to, it's just another example of how capital is going to go to where it's treated best and be as efficient as possible. So it is better than the IPO in that traditional sense for lockup periods and everything else. The interesting thing on the other side, Frank, is Goldman Sachs, which is a Curzio Research Advisory holding, betting with the worst of the people. We just can't beat them, join them type attitude there, a little tongue in cheek. Mm-hmm. But on the recent conference call, it was interesting because they said, hey, even if this slows down, and I'm paraphrasing here, these companies are going to have to continue to raise capital, right? So Goldman Sachs is in on a lot of these SPACs, getting fees, investment banking fees and all that. Well, going forward, if they're not working out as well as they think, they're going to have to raise more capital, which is just another pipeline and income stream for more Goldman Sachs and investment banking. Yeah. So, again, pay attention to what's going on. If the retail keeps bidding them up, that's great. But this is going to be another positive for banks.